Aussie interest rate cut, why it won't solve mortgage stress.
A rate cut won't be enough. For months, Australian homeowners have been eagerly awaiting news of an interest rate cut, hoping for relief from the financial burden of soaring mortgage repayments. The Reserve Bank of Australia, RBA, is widely expected to lower rates in February 2025, but new data suggests that this move may not be the game changer many are hoping for. Despite the anticipated reduction, financial analysts warn that a single rate cut will do little to ease the immense mortgage stress gripping Australian households. The reality is that the impact of rate reductions is often marginal, and most borrowers need multiple cuts before they feel any real financial relief.
So, why won't this rate cut make a meaningful difference? Let's dive deeper into the numbers, expert insights, and the bigger picture of Australia's financial landscape.
Understanding mortgage stress in Australia. Mortgage stress occurs when households struggle to meet their mortgage repayments while maintaining a reasonable standard of living. According to Roy Morgan's latest data, 1.595 million Australian households are currently at risk due to high mortgage costs. If the RBA does proceed with a rate cut in February, the number of at-risk households is only expected to drop to 1.542, a decline of just 53,000 households. While any relief is welcome, this is a fraction of the total mortgage holders facing financial hardship. This begs the question, why is such a small percentage of homeowners benefiting from a rate cut, and what does it mean for the broader economy?
Breaking down the impact of a rate cut. To understand why a rate cut won't be the silver bullet for mortgage stress, it's essential to examine how much homeowners actually save when rates drop. For a homeowner with a $1.4 million mortgage, a decrease from 6.75% to 6.5% would reduce their repayments by approximately $107 per fortnight. While this amount may seem significant at first glance, it barely makes a dent in the broader financial pressures households are facing. Many Australians are not just dealing with high mortgage repayments, costs of living have skyrocketed, wages have stagnated, and inflation continues to eat away at household budgets. For families barely making ends meet, $107 every 2 weeks is simply not enough to counteract years of financial strain caused by higher interest rates and rising inflation. The real problem: inflation, wages, and household income. Interest rates are just one piece of the puzzle when it comes to mortgage stress. According to Roy Morgan CEO Michelle Levine, the biggest factor determining whether a homeowner falls into mortgage stress isn't just interest rates, it's household income. Wages in Australia have failed to keep up with inflation, meaning that even as mortgage repayments increase, household earnings are not rising at the same pace. The past few years have seen a sharp rise in essential costs. Food prices continue to climb, with grocery bills significantly higher than pre-pandemic levels. Utilities such as electricity and gas have surged due to supply chain issues and global market fluctuations. Petrol prices remain volatile, putting additional pressure on household budgets. For mortgage holders already struggling, even a slight relief from interest rates won't undo the financial damage caused by years of increasing expenses. And additionally, many Australians have depleted their savings in an attempt to stay afloat. The high interest rate environment has forced households to cut back on discretionary spending, meaning that even if rates do drop, it will take a long time before financial confidence is restored. A growing crisis: the extremely at-risk homeowners. While 1.542 million mortgage holders are classified as at-risk, a more severe category exists: the extremely at-risk group. Right now, 973,000 Australian households fall into this category, meaning they are at severe risk of defaulting on their loans. This number is significantly above the long-term average of 14.6%, reaching 17.4% of all mortgage holders. This isn't just a problem for individual homeowners. It has broader economic implications. A high rate of mortgage defaults could impact banks, property markets, and overall economic growth. If economic conditions don't improve, if wages remain stagnant, inflation persists, and cost of living pressures continue, many of these extremely at-risk borrowers could be forced into selling their homes or facing foreclosure. Where are interest rates headed? The RBA is set to hold its first meeting of 2025 on February 17 to 18, with analysts from all major banks predicting a cut from 4.35% to 4.10%. However, even if this prediction holds true, financial experts believe multiple rate cuts will be required throughout the year before Australian homeowners see any real financial breathing room. Many economists anticipate further cuts later in 2025, possibly bringing the cash rate down to 3.85% by the end of the year. But whether this will be enough to reverse years of financial strain remains uncertain. Some key questions remain. Will the RBA act aggressively and make deeper cuts throughout the year? How will the property market react to these changes? Can wage growth finally catch up with inflation to ease pressure on households? Final thoughts. The bigger picture. While an interest rate cut may provide some psychological relief to homeowners, the actual financial impact will be minimal, unless followed by further cuts and broader economic improvements. To truly alleviate mortgage stress, wage growth needs to accelerate, inflation must stabilize, and cost of living pressures must ease. Without these changes, even multiple rate cuts may not be enough to bring back financial stability for millions of Australians. So, while the February 2025 rate cut is likely to happen, the road to financial relief is still long and uncertain. For mortgage holders hoping for a quick fix, the reality is far more complicated. What do you think? Will the RBA's expected rate cut in February be enough to ease financial pressure? Do you think mortgage stress will remain high throughout 2025? Should the government do more to address cost of living issues? Let us know your thoughts in the comments below. And if you found this breakdown helpful, consider subscribing for more updates on Australia's economic landscape. Stay informed, stay prepared, and we'll see you next time.